Okay, I'm going to give you some background about myself quickly. I worked at Man Group, and I was head of their Dimension Multi-Strategy Fund. I also worked at GLG Partners, and most of my career was actually spent as a discretionary trader. I founded and ran quite a big hedge fund backed by Man Group, which did special situation and relative value trading. I was also worked for a series of investment banks, and I was managing director at the Royal Bank of Canada in charge of structured credit trading and principal finance. I published a book on all my days of all the crazy products which we sold to and structured to investors a few years back. And originally I was a physicist. I was at Cambridge and CERN and various European labs. So since I'm a physicist, when one talks about machine learning, I always come back to John von Neumann, who did everything from foundations of quantum mechanics, game theory, self-replicating machines, and the H-bomb. And a famous expression which he came out with, which is 4 parameters I can fit an elephant, and with 5 I can make him wiggle his trunk. And that's a statement on overfitting. Von Neumann perhaps wasn't correct about everything. He was a strict adherent to game theory and thought we should drop the H-bomb on the Russians before they developed one. So, anyway, the machine learning toolkit. There's lots of different machine learning techniques, and for classification and regression, here you can see for 2 different data sets how different techniques might categorize the data. What I'm going to talk about today is perhaps one of the simplest ones, which is KNN, which is a nearest neighbours technique. But some of the others can give amazing fitting power, overfitting power, like neural nets. But Python provides a great toolkit for most applications. Now, the benchmark for most machine learning techniques is the NIST handwriting data set, right? To try and recognize handwriting. And all different ML techniques pretty much come out with the same success rate, which is like 1, 2, 3%. There you can see neural nets, nearest neighbors. If you go on the website, there's lots and lots of different types of machine learning techniques. And they all pretty much achieve the same thing, given a problem like that. But in the financial markets, the data's noisier and much more limited, which I really want to talk about quickly. For example, a couple of years back, a very famous and sort of much hyped paper came out on deep learning between cats and dogs, recognizing images. And they used a sort of multi-layer neural net to determine the difference between cats and dogs. Well, in finance, there isn't really lots of cats and dogs. There's only one financial history. So obviously, most of the machine learning techniques which are out there and have been developed for other applications aren't really applicable to finance. In financial markets, there's only one history. So a typical systematic model is you have a training data set, you do some initial parameter fitting, you then test it on some data. If it doesn't work, you just go back and change your systematic model, okay? And you do this time and time again. It's like a big feedback problem. So effectively, you have no out-of-sample data, and then it doesn't perform well in actual trading. The more quants you have in your team being paid to data mine, generally the worse the problem, in the absence of any new ideas. Market data is also very noisy. Most of the signals are very small. It's nearly very close to 50-50. If you find a signal which is better than 55%, you're doing pretty well on an individual trade. Machine learning is meant to solve many of these problems because you train using a walk-forward method, but really it's difficult to avoid this problem whatever you use. And as a scientist, I believe the best way is, former scientist, is to keep models as simple as possible and with some fundamental rationale behind them. Also, another problem with systematic models is the regime change. I mean, I was The fundamentals have changed over all these years. This goes back to 1995. It's the S&P. It's actually a chart from a talk I gave end of last year before the recent crash. And the fundamentals have changed. So, for example, we've had Russia, Asia, Eurozone crisis. I was shorting Asian credits with default swaps back then in sort of before 2000. It was a long time ago. The market was very different to today. We've had dot-com crisis. In the bull market during the dot-com era, the volatility was much higher than in the recent period we've had of bull market. We've had quantitative easing. All the markets are totally fake these days. I mean, the biggest buyer of Apple shares when there's a dip is the Swiss National Bank. The biggest holder of exchange-traded funds is the Bank of Japan, right? They've moved out of bonds and into equities. So the market has changed. The technicals have changed as well. From about 2010, there was high-frequency trading in markets. Computer power per dollar has changed. There's more and more money in quant funds. Most strategies are now crowded or don't work anymore. There was a paper published, I noticed, which someone showed that once a strategy is published, it loses 50% of its alpha. Well, I happen to have experienced that myself because two of my favorite strategies, one of which was an end-of-the-month effect, as soon as it was published, it no longer worked after sort of 20 years of working perfectly. So people say machine learning is adaptive to regime change, but in practice, it's only adaptive very slowly within the limit because you're limited by statistics and this one history period. So what I'm going to talk about today is the nearest neighbours approach, or KNN as people call it, which is the simplest of all machine learning techniques. It doesn't require a function. It just uses a local approximation for a decision boundary. So we have, for example, we take all the training examples and we put them in a multi-dimensional space. So if, for example, as we have below, bottom two features, feature 1 and feature 2, then we take the nearest neighbours to our data point and we see what happened in the past and we make a categorization or regression on those. So for example, if we took the nearest neighbour, we would say it was blue. And if we took the three nearest neighbours, we'd say it was red, our data point. And you can assign weights to the data points, and you can also include a distant function. There's different ones like Euclidean, etc. What this allows you to do, I think, which is very powerful about KNN, although most people sort of poo-poo it slightly, is that you can actually tell what your model's doing because it's not really a black box. You can say, for example, if feature 1 is high and feature 2 is low, then we're more likely to have a red dot than a blue, for example. You can see what's happening with your data, which is in complete contrast to things like neural nets where you don't really know what's going on. So our typical model for market prediction in KNN will be we take some features. We could either have raw data, daily returns, trends, reversion, volatility. We can pick those as dimensions of our KNN space, and then we normalize them. We have our engine, KNN engine, and we then try and we take today's data point, for example, we see what happened historically based on the features we have, and then we try and make a prediction, an average historical risk-adjusted return of the K nearest neighbors to make a prediction for tomorrow. And then that determines whether we buy or sell and our position size. So it's a very simple technique. We have to have a history or library of what happened in the past and compare it to today. So what's the difference between algorithmic versus machine learning or KNN? Well, algorithmic, you start off with a concept, like for example, we buy equities when they're good value, okay, and you develop a strategy like that. In machine learning, you try and find the strategies, what the rules are for the strategy. I think an important point is in most people in algorithmic trading combine their signals as a linear combination. They add the signals together. But in machine learning, because we can look at different parts of this multi-dimensional feature space, it's non-linear. Algorithmic, you have an underlying equation or algorithm. That's not the case. You discover an algorithm in KNN. There's algorithmic, systematic is not adapted to market regime. Well, machine learning is, but very slowly. You have to have enough data to sort of statistically support the slow change in your model. And I think that KNN is intuitive like most systematic trading models. So for an example today, I'm just going to talk quickly about long-short equity for the S&P 500 for a market-neutral portfolio. And what we would do is it would take, we reduce the problem to a six-dimensional cube, a 6D problem, okay? So we take several factors, for example, long-term, short-term momentum, short-term reversion. We'll take some ranges of recent data points. We'll take the volume traded, and we'll take an alternative data dimension as well. We're not going to have short-term trading. We're going to hold less than 10 days. So we're going to ignore things like fundamental value, company size, all these things which are slow-moving. We do a walk-forward training with no knowledge of the historical history until we've walked through those data points. We roll forward in time, and we'll wait towards the more recent data, the last 5 years, and we'll include modeling. Then effectively you end up with a signal which we short. We rank all the equities, and we buy the highest X%, and we sell the lowest ranked X%. And everything is volatility normalized to make it market neutral. So, for example, in long-term momentum space, if the ranking is along the bottom, we can see that long-term momentum, if the ranking's low, then we should short it over time and buy it if it's a highly ranked. And short-term momentum and reversion is the same, and range has a particular form. And we can combine these in the KNN architecture to put them all together to give us combine all these features, which individually they're all profitable, although they might have low Sharpe ratios. The features themselves actually have low correlation between each other. And then we want to include an alternative data dimension because it's presumably uncorrelated to all the other dimensions. And we have our own, we don't use Ravenpack, we have our own proprietary homebrew way of doing things in which we have about 4 data sources. We use some APIs, we do some data scraping off the web, and we build a database of news articles with things like headline, summary, abstract, the article. We've got about a 10 to 15 year database, and what we do is we put it through a natural language processing engine. Originally we started with just keyword analysis on things which we thought were important, and over time that's actually become a lot more sophisticated to read the sentiment of articles. And then we categorize and score the events under things like importance category, sentiment score, abnormal news volume, which I'll talk about, this sort of thing. So for example, these are typical events which we might categorize. We have corporate events, merger, buyback, results, spin out. We have ESG events. One of the things about my company is we're focused on ESG investments. So we include that as a factor in our selection. And ESG events are actually quite important. They're things like fires, leaks, strikes, things like this, and also things like fraud or resignations in company, corporate governance. And quite an important one, which we've started looking at in more detail, is innovation. When companies publish more innovative, there's more news articles on innovation coming from the company. So I say the perceived wisdom on alternative data, some of which we agree with and some we don't, is large cap equities, things like sentiment effects, are very short-lived. The example here, we're doing large cap. We're not doing mid and small cap. The effects are larger, but the transaction costs are higher. Sentiment score effects are smaller in large cap. The effect of negative news is often bigger than positive news and can lead to bigger sell-offs. The reaction to news is non-linear, and persistent good news has a saturation value. In the bull market, most news is taken as positive. For For bigger effects, we find abnormal news volume, what Ravenpack calls buzz, is important. That's like news coming out above a baseline of noise. For example, there's lots of news articles of, say, a company like Apple. But for example, if there's a huge amount coming out above a baseline, then that's more important than just news in itself. And also we find that surprise value is important. News can already be factored into the current price, particularly in large cap stocks, where it's almost like buy on the rumor, sell on the news sort of thing. So what we do is we take our sentiment score out of our model and our abnormal news volume, and we combine them into one dimension, so one feature. And just that feature, we find the top there is the performance of it. It has a Sharpe ratio of almost 1, which I actually found quite surprising when I first encountered that, because it actually has no price information at all in there. It's simply selecting and ranking stocks on the basis of abnormal news volume and sentiment. I would say abnormal news volume is actually quite a good measure of surprise in news, but I think that, and has a much bigger contribution than sentiment score, but I would say that a lot more work could be done on that, which I'll talk about in a minute. So at the bottom there, in the middle you see the market, what the market would have been doing if you were just long those equities. And at the top of the bottom, the blue is long and the orange is short over that period. And here's an example of what you can do with KNN, because it's non-linear. Here's a plot of our alternative data ranking against our momentum ranking. Now, if you kind of blur your eyes slightly, you can see that it's bluer on the left than it is on the right, which means that so the negative momentum stocks are more likely to go down, and on the right it's sort of warmer, then they'll go up. But you can also see there's a slight distribution vertically with the alternative data ranking. So if in KNN we have today's data value and we determine today's alternative data ranking and momentum, and we stick a point in there, then we would measure the nearest neighbours, or the returns of the nearest neighbours, and we would make a prediction. What we do is we do that in 6 dimensions. Okay, so we have all the other factors as well as dimensions. Now, what we find is news events, they can interfere positively or negatively with the existing price-based features, but using KNN, you automatically takes that into account. Data fitting. So if we combine all our features, our price-based and our alternative data feature, then that's the top is the account curve for the model. So if we look at the middle is the market, we find that it has a good Sharpe ratio. Long term, it's been like 1.9 after costs, with a stable volatility and low correlation. When, like 2008, 2009, in a bear market, we find the shorts have protected the overall portfolio. The orange line at the bottom is the shorts. But you always lose money on your shorts, because predominantly it's been a bull market, obviously. And we noticed that the alternative data has about a 0.3 contribution to the overall Sharpe ratio. 2017 is a pretty flat year. It didn't really make much money. Equities were bullish in the Trump rally with very little discrimination. But our alternative data feature, if I go back a while, actually performed well. It actually made money in 2017. So actually made money in 2017. So I think what I've illustrated is that KNN is a easy non-linear technique for combining traditional and alternative equity signals. Although there's a reasonable standalone performance for the alternative news data, once you mix it in with the quite powerful price-based data, it only supplies a small increase to the overall Sharpe ratio. But I think there's really, with all this alternative data, we're just skipping, still on the surface of what is possible as we collect more data of what you can do. For example, we treat all the equities as sort of homogeneous. We throw them all into that 6-dimensional pot, where really you should follow the history of each equity and determine better the surprise value of news for that equity, which is hard to do, to come up with some form of algorithm to do that. Also, faster trading, if the effects in large cap equities are short-lived, really you need to analyze intraday continuously the articles and trade intraday, but there's much higher costs to do that. We don't yet do that. And also I think you can have better features both for price, axes, etc. You can always discover new things, and which have a good conceptual intuition behind them. And then KNN can provide a non-linear way of combining those signals. Okay, that's me done.
This is Raven Pack.